If you're interested in cash value life insurance and you think, oh my gosh, like this topic is way too complicated, there's way too much going on, so many competing voices in the space, you're in the right place, because today we're going to talk about what makes a policy good that might not show up on a simple illustration. Hey, it's Matthew Decker. I run Cash Value Life Insurance Reviews and Leveraged Wealth Management, where we specialize in cash value life insurance for high income earners. And I've got to say, I'm really excited about doing this video because so often in this space, everybody uses an illustration or a policy projection to convince a prospective client or to convince you that one thing is better than the other. And oftentimes those documents are, 40, 50, 60 pages. There's all kinds of provisions in there. Each company uses different language. Maybe they have the same fees, but they call them something else. And so doing comparison can just be very difficult. And so the reason I wanted to shoot this video today is because I want to talk about something that you're not going to see on an actual illustration. So let's talk about kind of the behind the scenes. What makes a policy good? What makes a company stable? And what makes them consistent? There's a few things here that will go a long way in just understanding this industry as a whole. So let's just talk about what is it that makes a company stable? What is it that's going to make them consistent? And so the first thing is going to be cap integrity. And what the heck is cap integrity? Cap integrity. When you look at a policy and an illustration, it's going to have a ledger, and they're going to have, all their investment selections, and each investment selection is probably going to have some kind of cap, and they're probably going to have a participation rate. We'll just say par rate. And so maybe you've got a 12% cap and 100% par rate. And then you've got maybe an 8% cap on some kind of small cap fund, 100% par rate. Maybe you've got a volatility index with no cap. So it'll say NA. And then maybe the par rate on it's 135. So higher than 100%, so on and so forth. None of that really matters. But what you need to understand is that caps are set every single year. So the company is going to go in, and every single year, they're going to have an options budget that they have for that year. And that options budget is going to be largely driven by their overall portfolio, the return on their bond portfolio, I guess is the easy way to say it, their portfolio rate. What are they earning on their dollars that they've invested over the long run? And so if interest rates, again, generally speaking, if interest rates go up, that would mean that the company should have more dollars to spend on their options budget. And if the company has more dollars to spend on their options budget, you should really see two things. The first thing is you should see that their fixed rate, and every company should offer a fixed rate, is going to go up. So their annually declared fixed rate should go up if interest rates go up. The second thing that you should see is that some of their caps should also go up. And the flip side is also true. If interest rates, we'll add some context. So this is interest rates. If interest rates go down, then what you should see is you should see the fixed rate go down, and you should see some of the caps go down. Not always, but most of the time, that's what you should see. What does this have to do with cap integrity? Well, I suppose that there are two main types of companies in this space. There are the companies that have been in this space for a long time, and they will continue to be in this space. They have a large market share, and for the most part, they're going to price their products for the long run. They already have the market share. They don't need to play any games with anybody. And when they come out with a product, generally speaking, they're trying to price their product to be stable. That's the first type of company. The second type of company would be a company maybe that's newer to the space, or maybe they've partnered with a different company to come up with some kind of hybrid product. And what they're trying to do is they're trying to grab market share. So if you have a new company that doesn't have a big market share and they need to go out and they need to go get some market share, one of the easiest ways to do that is to take their ledger, their index ledger, they've got all their different investment options, and artificially go in and juice the caps for the first couple years. So maybe you got a 15% cap. That looks like 13, but I promise it's 15. Maybe they've got that 8% cap on the product above. Maybe it's now a 12% cap. And that volatility index that has no cap, maybe it's got a 250% participation rate. Okay, all that's well and good, and they're totally in their right to do that. But you just have to understand that if a company's trying to grab market share, it means that they've priced their product unsustainably. They have not priced it with the future in mind. They've priced it with that year in mind, or for the next 2 years in mind. And after that product has run its course, they're no longer going to sell it. And what they're going to have to do is they're going to have to go back in and drop all of their caps because it was unsustainable from the beginning. They priced it to grab market share. Why are we talking about this? Well, you need to know what type of policy you're buying because, as we said at the beginning, you're probably looking at an illustration. And that illustration is probably showing you projected cash values. It's showing you maybe projected income, projected death benefit based on this premium that you're paying, and based on the growth of the policy. And the growth of the policy is based on those cap assumptions that the company is using. Because when the company shows you an illustration, they show you the illustration based on the caps today. Even though they know, hey, we're grabbing market share and in the future, we're going to have to dump these caps. They're not going to show you that on the projection, okay? So when you're choosing a policy, what makes a policy good? Well, you're going to want a policy that is priced for the long run, where the caps and the rates are as stable as they can be. And how do you know if they're as stable as they can be? Well, you want to know that that company has a track record of keeping their caps relatively close to where they started. And there's certain companies that don't have that track record. I'm not going to name them here, but if you want to ask us, you can certainly ask us. Book a meeting with us. We'll tell you who it is. But most of the big A-rated companies don't play this grabbing the market share game because they already have the market share. They don't need to artificially blow their caps up for a year just to reduce them later. Okay, so that's the first thing that you definitely want to watch out for, and that is cap integrity and keeping caps near or at where they were originally set when you purchased the policy, knowing full well that over time, caps are going to change. It's going to be based on essentially the interest rate environment. Interest rates go up, caps go up, fixed rates go up. Interest rates go down, cap rates come down, fixed rates come down. Okay, the second thing, what else makes a policy good? Well, you want a company that is focused on long-term policies, LTP. I just made that up. That's not long-term care, that's long-term policies. What do I mean by that? Let's say multiple premiums. Some of you have probably seen or looked at annuity products. And a lot of indexed annuities function actually a lot like indexed universal life insurance policies. The main difference, so if we had an annuity policy over here and we had an IUL over here, the main difference between an annuity and an indexed universal life insurance policy is in the annuity contract, you're going to take your money and more often than not, one time, you're going to dump it into the annuity product. And that's it. One premium, one time, you let it sit and grow. What that means is the company that is backing the annuity, they have to take those dollars and they have to price that product based on interest rates today, which means you're going to have lower rates, lower caps, lower crediting for the most part in annuities. How is IUL different? Well, IUL is different because you're going to take money and you're going to dump premiums in for several years in a row, sometimes 20, 30 years. And so in the indexed universal life world, the company doesn't have to take all your money at once and invest those dollars today at today's rates. They get to invest those dollars for the next 20 years at whatever the rate environment is when you put the money in. And that has a huge impact on caps. So one example would be there is an indexed universal life insurance company. And again, I'm not going to name them because it doesn't do any good to name them, but there's an indexed universal life insurance company that had two main products. They had their flow premium product, which is like this policy here that we just talked about, multiple premiums over several years. And they also had a single premium life IUL. Single premium, it should probably just be single premium life. Yeah. They also had a single premium policy, and this single premium policy was focused on one payment and kind of like max cash in year one. And they did a ton of this single premium business. In fact, they pitched it as a bond alternative or a CD alternative. They even had like a whole company sponsored branded sales strategy. I think it was called something like Lazy Money, or it was something like that. But the idea was, hey, if you got a couple $100,000 in your bank account earning zero, man, take that money, put it into this single premium life insurance policy. At least it's going to grow. And guess what? It's focused on maximum cash in year one. It's a great solution. And for the most part, it was a good solution. But here's what you have to understand. That company took millions and millions of dollars in single premium policies when interest rates were near all-time lows. What does that mean? What that means is they had a huge influx of cash when they couldn't earn very much on it. And because they couldn't earn much on all this single premium business, it actually negatively affected the cap rates on their flow premium product. So their regular flow premium IUL, where you've got your contract and every single year you're going to dump in some money, and it started with a cap rate, I believe it was around like 12.5%. Well, this company took on a ton of money in the single premium policy. And that single premium policy, because they were investing at today's dollars and they weren't getting future premiums, it reduced the overall return of their whole book of business to the point where 3 to 4 years later, that same flow premium product had something like a 9% cap. And the reason that it got crushed so hard is because they took so much money in the form of that single premium product. So this one's going to be a hard one to decipher on your own. If you're working with us, we have a really good understanding of which companies are doing what type of business. And if we're looking at funding an indexed universal life insurance policy for the next 15, 20 years with maximum cash and income as the goal, we're going to avoid companies that specialize in single premium life policies, because ultimately those single premium life policies are going to reduce their caps and their rates. It's essentially turning a life book of business into an annuity book of business because it's single premium products, and you don't want that on your life insurance policy because it just simply means lower caps and lower rates. So what else makes a policy kind of worth its salt? Well, the next thing that I would say would be bonuses. Ooh, that was, didn't mean to do that. Let's get back to blue. So bonuses, what the heck do we mean? Well, most of these index life policies now, and really almost all cash value life insurance policies at this point, have some form of kind of bonus baked into the illustrations. And so what's important for you to know is that bonus guaranteed? Yes or no? Some companies will do something like this. They'll say, hey, for years 1 through 10, we're going to pay you 1.5% as a bonus. And then when you get to year 11, so year 11 on, we're going to pay you 2%. We're going to up it from 1.5 to 2% every single year. And that's what they'll show you on the illustration. But then when you read the fine print, and the fine print will be, like much smaller, or maybe right below this section, it'll say, the guaranteed bonus is actually only, 0.55%. So we're showing you 1.5 and 2, but we don't actually have to pay 1.5 or 2. All we have to pay is 0.55. Well, hey, that's something you want to know, because if you're looking at projections based on bonuses that have no contractual backing, that would be something that I would want to know. The second piece of this is, okay, maybe the bonus is guaranteed, but does the bonus come with a fee? So do you have to pay for the bonus? And a lot of companies will make you pay for the bonus. And so then the next question is, okay, if the answer is yes, there's a fee for the bonus and I have to pay for it, is the fee guaranteed? And you might say, what do you mean? Well, the fee might start out saying it's a 1% asset fee. But then again, somewhere else on the ledger, maybe in the fine print, maybe an asterisk that shows up maybe 2 pages after the ledger, you'll see maybe something like this. And then you'll see a little disclosure and it'll say 1% non-guaranteed fee. And then it'll say something like maximum of 2%. And that would be something that you would want to know. If the fee can change, well, man, I want to know, number one, how can it change? And then number two, I would really love to know, we've got this 80-page document here. That's the illustration. What are these numbers based on? Is this based on the 2% bonus? Is this the 2% bonus and the 1% fee? And if that's the case, man, you're showing me a pretty rosy picture because you've given yourself the opportunity to lower the bonus and increase the fee. And that doesn't seem like that would ever help me. Can it go the other way? Can you increase the bonus and lower the fee? And I think you know the answer to that question. No, they're not going to increase the bonus and lower the fee. If they give themselves room to lower the bonus, and if they give themselves room to increase the fee, that is the only direction that they will be moving in. And I want to know what companies are going to be doing that so that I can just say, you know what? I don't think that's a good policy for me. The last thing I want to touch on, I guess we'll do 2 more things real quickly. Sweep dates. The companies that are doing the most business are going to have what's called daily sweeps. And so a daily sweep would mean when you pay your premium the next day or that day, that money goes into the index. Companies that don't do tons of volume, they're going to take in premiums from, all kinds of people, and it's going to sit in a holding account, and it's going to sit there until the 15th of the month. And then at one time on the 15th of the month, the company is going to take all the dollars from all the policyholders that have been paid, and then they're going to go invest in the index. And that's just not a deal breaker. You just need to understand that a company that's not doing a ton of volume, that's how they're going to do it. And it's a good indicator of how much volume they're actually doing. If they're doing monthly sweeps like this, where they take your money, put it in a holding account, and then wait till the 15th or the 18th or the third Wednesday or whatever it is, that means they're working through an investment bank and they're paying a fee to that investment bank to facilitate their index purchasing. And so it just means that there's more costs associated with this type of policy that has less frequent sweep dates because they're absolutely working through an investment bank. The last thing that I just want to say on this point is what makes a policy good? Well, you should definitely have a good understanding of the company rating. And so I pulled a snapshot of the Comdex scores for just kind of like the top life insurance carriers. Symetra at a 79 there. You'd have to have a really good reason to go below Symetra at this 79. If it were me, I would be sticking to companies that are in the 80s or above on the Comdex score, just because when you zoom out, these companies have strong cash positions, and because they have strong cash positions, they're not going to be the companies that are going out there buying market share with kind of pseudo fake products that are going to change in a couple years. You don't have to worry about that, number one. And then number two, it's going to be easier for them to absorb changes in the interest rate environment. And they should have, hopefully, if they're doing business the right way, they should have better cap integrity and products built for the long haul compared to maybe a fly-by-night company or a new player in the space that's trying to, again, soak up some market share. So what makes a company good? Well, I would say that there's a lot going on that you're not going to see on the illustration. And if you're looking for an expert to talk through some of those things, you should absolutely book a discovery call with us. You can do that right here. It'll take you to our website where you can fill out a few questions and get on the phone with us for 15, 30 minutes. And we'll try to find something that's going to be the best fit for you. And if this isn't going to be a good fit for you, we'll tell you. The last thing we want to do is put you into a policy that's not actually going to accomplish your goals that you've set out for yourself. So there's a lot that goes into these good policies. It's hard to decipher it just by comparing an illustration to another illustration. And I want to encourage you, if this is something that you're exploring, reach out to us. We would love to help you. This has been Matt Decker, Cash Value Life Insurance Reviews and Leverage Wealth Management. Take care.